10 most promising penny stocks to buy now. To select the most promising penny stocks, we used TypeRank's stock screener. We focused on penny stocks with strong buy recommendations and average analyst price targets that are significantly higher than their present prices. We sorted the resulting dataset based on companies' potential upside from their current levels, as determined by the average analyst price forecast. Hello everyone, and welcome to a brand new video on the channel. Today, we are going to talk about 10 most promising penny stocks to buy now. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 10, Aerotech Corporation. The military business may appear to be an unlikely place to find a penny stock, but Aerotech fits the requirements. It has a market capitalization of $88 million, yet it works in a number of countries and competes with huge names such as General Electric and Honeywell. In terms of fundamentals, the stock has a forward P/E ratio of 13, which might be low if the company can accelerate its growth. Their 2017 revenue was $98.72 million, over $5 million less than in 2014. And given that the company was started in 1990, it's been a long road to success. In 2017, the company's earnings were 17 cents per share. Number 9, MSIG. The question investors must ask about MSIG is whether they believe the current trend of legalizing marijuana will become a reality in all 50 states. MSIG is a marijuana-growing building company, which means they help farmers create greenhouses and other infrastructure required to manufacture their product. Currently, the number of licenses issued in a given state is strictly controlled. That is what fuels MSIG's promise. However, numerous states that have legalized marijuana are already reducing their limits, creating competition and driving down the price of marijuana, forcing some growers out of business. Number 8, DHX Media. In the realm of digital media, content is king. This may give investors a sense of optimism when they consider DHX Media. This year, the stock has suffered significant losses. However, after a 35% drop, it may have reached a bottom. It's now trading near its simple moving average. DHX Media would definitely be a sector play. As more people cut the cord and go to digital and streaming media, there are opportunities. Number 7, Plug Power. Insanity is defined as doing the same thing repeatedly and expecting a different outcome. Investors should be delighted that Plug Power is trying something new to increase shareholder value for its shares. Although sustainable energy has historically struggled to generate a return on investment, the hydrogen fuel cell developer hopes to reverse that narrative. Plug Power signed contracts with Amazon last year and teamed up with FedEx in May. Number 6, Limelight Networks. Any choice to purchase Limelight Networks should be predicated on where you believe the future of streaming content is headed. Limelight builds content delivery networks, CDNs, to assist businesses achieve efficient, customized performance and content availability. According to industry estimates, CDNs would handle 71% of all internet traffic by 2021. This is a considerable gain above the 52% they carried in 2016. This is mostly owing to the increased demand for buffer-free streaming content. The stock is currently trading around $4.85 per share and recently broke over its 50-day SMA. Number 5, Sportsman's Warehouse. With a trailing P/E ratio of 11.5, which is much lower than the S&P 500, and same-store sales growth of 3.4% in the first quarter of 2018, Sportsman's Warehouse is sending out strong technical signals that it is undervalued. However, analysts are skeptical of their sales numbers. While the company reported a profit in its most recent results statement, earnings per share, measured under GAAP standards, remained flat year-on-year at $0.15. Number 4, Castle Brands. Castle Brands may be an example in which the market has already established a floor for its shares. If that's the case, there are reasons to believe that the stock is due for a run. First, it has two attractive product offerings: the dark and stormy drink, produced with its Gosling brand of Black Seal dark rum and ginger beer, and the Jefferson Bourbon brand, which continues to anchor its whiskey portfolio and boosted revenue by 20% in 2018. Their profit remains low, but their margins have improved in recent years, and sales continue to rise. The company has 166 million outstanding shares, which may cause some negative pressure on the stock. Number 3. Advantage Oil and Gas. Advantage Oil and Gas is an appealing option for investors seeking a more established oil and gas company. In its second quarter earnings report, the company reported a year-over-year fall in both the top and bottom lines, putting downward pressure on the stock. However, in the first quarter, the company's profit margin was 29%, significantly higher than the industry average of 6.1%. And that profit shows no indications of stopping due to the factors that are pushing greater demand for Canadian oil, such as Iran sanctions and predicted production concerns in South America. Number 2. Mid-Con Energy Partners LP. Mid-Con Energy Partners demonstrates the hazards that small-cap oil and gas firms face. In 2013, this company's shares rose to $27 per share. However, when oil prices plummeted from 2014 to 2016, Mid-Con's stock fell with them, plunging into penny stock territory. At one point, it was trading at $0.73 per share. Even as oil prices have risen, the stock has struggled to gain traction, trading at approximately $1.75 per share. Number 1. Chesapeake Energy. The decision to buy Chesapeake Energy is largely determined by the direction in which you believe oil and gas prices will move. During the last downturn, the corporation suffered significant losses and incurred about $10 billion in debt. Their most recent earnings report showed mixed results. Year-over-year earnings fell significantly, with the company reporting a $40 million, $0.04 share loss compared to a profit of $470 million, $0.47 share the previous year. Total revenue declined from $2.281 billion to $2.255 billion. However, their adjusted earnings per share of $0.15 exceeded projections of $0.14. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up. And do not forget to subscribe. Thanks for watching. See you next time.